Well, thank you. Thank you, everyone. It is so good to see so many familiar faces. Thank you so much for coming today. For today, the format is going to be, I'm going to do about 5 to 6 minutes on GVF and just the 10-year celebrations that we're coming into. Then I'm going to ask Miles to talk about the US election, actually, and the various scenarios that might play out and how that might impact financial markets. And then we've got Mark Ambrose here from London. Mark and Miles run the portfolio together, and then we have 2 other portfolio managers in London as well. And we wanted to bring him round so that you guys could get to meet him. Okay, so let's get cracking. These here are the 2 CIOs. I am the CEO of a company in London called Staude Capital. Staude Capital is seconded into the ASX-listed Global Value Fund. And the Global Value Fund celebrated its 10th birthday in July this year, which is very exciting. We continue to have a very strong board. We've got Chris Cuff, Jonathan Trollope, Jeff Wilson, and Miles Staude. And as you guys will know, we run a unique strategy. You know, we're not your traditional stock pickers. Instead, we go around the world looking for a very specific type of investment. In Australia, those very specific types of investments are called listed investment companies, but in other parts of the world, they're called various different names, but they tend to share the following characteristics. They tend to be closed pools of capital, they tend to be listed, and they tend to be vehicles that can purchase any type of asset. So you can hold global shares, you can hold global bonds, real estate, private equity. Mark's got a case study on real estate, US real estate, and he's also got a case study on music royalties. It's an update on last year's story. Now, if you or I want to purchase the value of those companies, we go and buy a share on the stock exchange, and we would expect that the share is worth the value of the assets. But it's in cases where the shares trade at a big discount to the value of the assets that we will get interested. We will start to do our due diligence. Now, it should be said that we kiss a lot of frogs, we turn over a lot of stones, but when we do find an investment that we believe in, we like to say, and it works, we like to say to our investors that they get 2 sources of returns. First, the returns from the underlying assets that we've purchased at a discount, and then secondly, the returns that we get from unlocking the discount or getting the discount out. And using this unique strategy, GVF has done a great job over the 10 years. We've annualized at more than 11% per annum with considerably lower risk. And I'm just going to spend a moment talking about that risk element. I know a lot of people will talk about protecting your capital, but I think I'll just show you, and I have shown this graph before, but I think it's a really good illustration of how we protect the capital. This shows every single trade that we've ever done in the 10 years that we've been going, and it shows the associated dollar profits on the left-hand side and losses on the right-hand side. Hopefully, when you look at this graph, you can see 2 skews. The first is that there's more wins than losses. And the second is that the quantum of the wins is greater than the quantum of the losses, which are 2 statements I really would like to hear when it comes to my own investments. Now, before we tuck into some cake, and there will be a cake delivered today, I want to make sure that we don't feel guilty eating this cake and that it's justified. So I wanted to dig a little deeper into how did the 10 years go. So I dug up the IPO prospectus and I looked at what was the IPO promise in the IPO prospectus. Well, the promise was GVF will deliver global share market-like returns, but it will do so with much lower risk. And I can tell you there was a lot of eye rolling because, of course, how many times have we been told, oh, we'll give you the S&P 500, but it'll be much lower risk. In that time, global share markets have absolutely killed it. In Australian dollar terms, from 1st of July when we IPO'd through to August 2024, so just over 10 years, global share markets in Australian dollars annualized at 12.3%, which was massive and magnificent. You guys will know it was the FANG stocks, the Magnificent Seven, have really driven the US economy higher, which has then in turn driven global markets. The 25 years before we listed, so from 1987 through to June 2014, global shares averaged 6.3% per annum. So it gives you a sense of how extraordinary these last decade has been. Australian share market has kind of behaved a bit more as we would expect. So annualized at 7.8% per annum. And over that time, GVF's average exposure to global shares has been less than 35%. So as you guys know, we go around the world finding these assets. We tend to hold a big chunk of global shares, a big chunk of global bonds, and then we'll have a smattering of other types of asset classes. We've run with less than 35% exposure to global shares, and yet we've still delivered that 11% per annum. On a risk-adjusted basis, GVF has outperformed global shares, has outperformed Australian shares, and has even outperformed the S&P 500. I can run you through the risk metrics that I've looked at in order to make that statement if you're interested. It's in the appendix. But I think being able to say something like that is pretty extraordinary and hopefully warrants the cake that we'll share together. A final data point for you: of 544 products in Australia that we looked at, 9 can say that they haven't had a down year in the last decade. GVF is one of those 9 products. The underlying assets performing well is great. The portfolio performing well is wonderful. But what has the shareholder experience been? That's important. Well, if you'd invested $10,000 with GVF at the IPO and you'd reinvested everything, your $10,000 would be worth $26,000 today. If you did half and half, we have some investors who take half of the returns and they reinvest the other half. Your $10,000 would be worth $20,000 and you would have received $4,000 in cash. Or if you're in the later stages and you're using this as an income product, because it very much has been designed that way, the default position is that we pay out all the returns to our investors. You would have invested your $10,000, you've received $8,000 in returns, and your $10,000 is worth over $12,000 today. Almost $13,000 actually. So hopefully that does a 6-minute job of reminding you guys of who we are, what we've done, and why we should share some cake after the presentation. I might hand over to Miles.
Thank you, Emma. No. So I've got a little confession to make. We've been doing this roadshow for most of the year. We started in May, and in every city we get a birthday cake, and there's a little private competition about which city does the best cake. So Brisbane, you're on notice today. We've got photos of them all, but we have got one turning up.
Well, yesterday was amazing. We're in Canberra, and I have to say, they did the number 10.
Oh, it's the cake, exactly.
And
yeah.
we were so, because we don't know what the cake's going to look like. We send them the spec, and then each cake maker across the country gives the spin on the cake, right? So then we get delivered the cake. Like, for example, yeah, exactly. So
well, I won't name the city. Well, unfortunately, one of the cities, they got the ticker for our company. A what?
A weight graph?
A weight graph of distribution. Maybe that's next.
Have to.
On to more somber points or topics. And I'll just do a quick little caveat here. So we don't spend a lot of our time designing the portfolio to take advantage of a specific big picture macro event. But Mark, myself, and the team spend a lot of time preparing the portfolio for risks, managing risk, protecting the downside in the portfolio. And the biggest near-term risk in financial markets today is the US elections. Whether you like it or not, it's happening. It's a few weeks away. I know a lot of us switch off when we talk about US politics and US culture wars, and I wish I could switch off a lot of the time.
Queensland elections this week.
That's what I'm talking about. I know exactly, the big market-moving event. But unfortunately, the outcomes in these elections really have the potential to move markets, and for investors, especially professional investors like Mark and myself, we have to pay a lot of attention. I want to be very clear up front. I've been giving this speech now for 2 weeks, and I've sat in rooms that were ardently anti-Trump and ardently pro-Trump. I haven't actually sat in the room that was pro-Kamala yet. It's very much pro-anti-Trump. Nothing about what I'm going to say today is an endorsement or a criticism of any politician. That's not my job in life. Instead, what I'm trying to do is provide a very narrow analysis of the election's impact on financial markets. That's what I'm concerned about. I'm not endorsing anyone. I'm not criticising anyone. Just to lay the groundwork, I mean, the things that we will have seen a lot in the paper, since Kamala Harris has come along, taken the presidential nominee from Biden, the Democrats have enjoyed a really big bounce in the polls, and she's certainly ahead by a few percent nationally. We see a lot of that in the press. In the real world, that doesn't make any difference. So for better or worse, under the kind of archaic rules of the US Constitution, the Republican Party enjoys a big structural advantage over the Democrats. It's not a popular vote contest. The vote is decided by this electoral college vote system. And what that means in practice for this election, there are just 7 swing states in the US that will determine the outcome. 3 in the Sunshine Belt, 4 in the Rust Belt, and as best as we can tell, the polling in those states is still neck and neck. It is very much a coin toss. The more important thing, I'll just sort of run through the big picture. I guess the thing that I think is much more important when thinking about financial markets and the implications of these elections. The presidential race takes all the oxygen out of the room. It's what gets all the attention. The thing that I think investors need to be focused on are the other 2 races taking place. So there's also votes taking place for the House, the US's lower house of Parliament, the House of Representatives, and the Senate. In the House, like the White House race, as best we can tell, g'day Dominic, as best we can tell, it looks like a coin toss. It's 50-50. The Democrats are ever so slightly ahead in the polls. The Republicans currently control the House, as you can see on this lovely slide here. The Senate race is the one you need to pay attention to. And if you don't remember anything else from today, this is the point that I'd ask you to leave with. The outcome in the Senate looks very, very different. US senators serve 6-year terms, and they're staggered terms. So every 2 years, a third of the 100 seats of the Senate come up for re-election. And in this election cycle, the Democrats have been dealt a really tough hand. Of the 34 seats that are getting run, because this is the US, only 8 are actually contestable. All the other seats, it's a complete foregone conclusion. It's a very partisan country. It's very clear who's going to win in Texas, who's going to win in California. These 8 states will determine the makeup of the Senate. The problem that the Democrats have is all 8 are currently controlled by the Democrats. So there's really only one way to go. Or to say it another way, the Republicans only need to win 2 of 8 to flip control of the Senate. And the problem that they face, the Democrats, is that a lot of these races in states that lean very heavily Republican, Montana, Ohio, West Virginia. The bookies, the bookmakers have had the probability of the Republicans winning the Senate at well over 70% for well over a year now, and that probability hasn't budged. It's stayed very constant for a long period of time. So whatever your view on politics is, the clear-eyed point that we have to take away from what we can see today is it's very likely the Republicans will take control of the Senate next year. And that has a we're not there yet. That has a huge bearing on
Where do you want to go?
just back to the states. That has a huge bearing on the presidential race itself. So under the US Constitution, one of the key functions of the Senate is to act as a check on the executive powers of the presidency. So the whole US system is designed around checks and balances. One of the key functions of the Senate is to act as a check on the powers of the president. They didn't want a king, they wanted someone held accountable. In practice, what that means is that a hostile Senate can make a president's life absolutely miserable. The Senate approves all the cabinet posts, all the judges, all the senior officials appointed throughout the government bureaucracy. And if you have a hostile Senate, they can obviously block any laws that the president wants to pass, and more importantly, make their life a bit of a living hell. So what that means, that creates a big problem for any Harris presidency. If she wins the nominee, she wins the election, she's almost certainly going to face a hostile US Republican Senate. And, you know, in a more optimistic time, you might say divided government's a good thing, that it forces everyone to work together in the centre. I don't think any of us think we're at that time in the US today. It's very easy to see us falling into the old grind where the Republicans block anything of substance she wants to do, just to be able to say at the end of her term she didn't achieve anything. So for better or worse, a Harris presidency probably means nothing changes. No laws get passed. We probably see a lot of pantomime, a lot of theatre, a lot of, you know, bitter fights, but no laws and nothing actually changing in Congress. If you flip the tables, however, and you give Trump the presidency with control of the Senate, things can actually change. Former President Trump's made 3 big campaign promises: deregulate the economy, cut the red tape, cut taxes, and raise tariffs. On that, we're going to run through all 3 later on in the presentation, but on that first one, he can do that unilaterally with control of the Senate. He doesn't need to pass any laws. So if we flip a coin and Trump wins with control of the Senate, big changes are coming in the US economy and in US government. And of course, the Republicans currently control the lower house. It's very conceivable that he gets all three branches of government, in which case he'd also be going after tax cuts. Again, would really change the makeup of the US economy. And I was reading a fascinating article the other day that was highlighting if Trump was to become president with all three branches of government, he'd probably be one of the most powerful presidents in history. 6 of the 9 High Court justices have been appointed by Republicans recently, with three branches of government under control. The Republican Party really could bring some of their kind of more aggressive policies to bear, I guess, in terms of changing the makeup of the US economy. Again, I'm not passing comment. What I would say is most, but not all, economists think that most of Trump's policies would harm the US economy in the long run. But in the short run, and this is something we'll come back to, they would be very stimulative. Inflationary, they probably boost markets a lot. I guess one of the things I want to highlight is you probably don't want to stand in the way of that if you're a dispassionate investor. So point 1, don't focus on the US presidential race, focus on the US Senate race. Point 2, and this is a little depressing, but I'll try and get through it in the most cheery way I can. What we need to understand is whoever wins the presidential vote, it's going to be incredibly close. It will be an incredibly close election. The outcome is probably not going to be known for a little while. And the thing that we need to remember is that in 2020, Trump claimed that he only lost due to Democrat cheating. Now, whether you believe that's true or not is kind of irrelevant. That idea has become Republican orthodoxy for the last 4 years. Something like 1 in 3 Americans believes Biden is an illegitimate president. That's kind of an astounding statistic. That means tens and tens and tens of millions of Americans believe that Biden won through cheating today. What a lot of people don't realise, I think, is that since 2020, the Republican Party's put a huge effort into legitimising that claim of cheating. There's currently 100 different lawsuits being fought all over the country contesting election rules and who's allowed to vote in the election itself. And why they're being so successful with this is, again, I'll keep saying for better or worse. For better or worse, the electoral system in the US is designed by the states. Each state writes its own laws on how you conduct an election, its own rules on how you determine the winner of that election. Most of these rules were written hundreds of years ago, and in some of the states particularly, they're not very well drafted. So that ambiguity provides a great amount of wiggle room for an aggressive Republican lawyer to make some claims. These lawsuits are basically focused on 2 things. Firstly, to lay the groundwork to contest the elections if they're close and they don't go the Republicans' way. And then secondly, very much more nativist, is just to remove people from the electoral roll. And to give you a sense of the scale of this, in Arizona, there's a big fight going on at the moment where the Republican Party is trying to remove 500,000 people, 500,000 people, from the Arizona electoral roll for this November vote. If you think about how close this election is going to be, 500,000 people will certainly make quite a big difference. More broadly, this claim that the Democrats can only win by cheating has created a lot of bad blood. Polling workers are getting issued with panic buttons on the day of the vote. There's dozens of death threats. I read this other kind of dispiriting article the other day saying one of the biggest challenges they have for the vote is getting people to do the job. Most of these are volunteer jobs. Many of the volunteers have said they're not coming this time. It's too scary. They don't want to be involved in it. And one of the big challenges they'll face on the day is just not having enough people to do the counting, which certainly creates a lot of the ambiguity that the more sinister people need to claim malfeasance. I'll say, look, I'm not a conspiracy nut. I do think even if we have a contested election, the system of checks and balances will hold. But the thing that I'm thinking about, that Mark and I are planning the portfolio around, is the potential for a lot of uncertainty and a lot of volatility in markets between November and January. So if Trump loses by a fine margin, it's almost certain they'll be contested. And of course, last time we had that situation, we had the Capitol Hill riots in the US. Another slightly depressing statistic, 1 in 5 American adults tell pollsters they're open to the idea of violence for political ends. Now, I hope most of them don't mean that, but gosh, there's a lot of people and a lot of guns. You don't need many of them to mean that for something scary to happen. You know, we've already had 3 assassination attempts on Donald Trump. So there's always the tail risk that something goes a little bit pear-shaped. Pulling that slightly depressing narrative all together, I guess the way I'd characterise it is, if Harris wins, even if you think she's the right choice for America, if Harris wins, it looks to be a bit of a hospital pass. In the short term, she's almost certainly going to face a contested election, a nasty fight for 2 or 3 months. And then in the medium term, she's going to face a very hostile Republican Senate that probably can and will block anything of substance she wants to get done. It's going to be a bit of a lame duck presidency. She'll be the first president in 30 years to enter office without control of parliament, to enter office without the ability to actually pass any laws. In contrast, rightly or wrongly, a Trump victory probably means a bit of a sugar rush for markets, and there's two scenarios we'll touch on in a minute. The first one I want to talk about is this idea of deregulating the economy, and it sounds a bit wonkish, a bit sort of like an economic wonk, but it's quite meaningful. So he's got three big promises at the moment: deregulate the economy, cut taxes, and raise tariffs. On the deregulation point, I want to double click on that because, as I was saying, with control of the Senate, he can do it unilaterally. He doesn't need to pass any laws. He made the same claims, the same promises in 2016 when he ran for office, and he largely delivered on them. What we can see here, thanks Emma, is a well-followed indice in the US. This is small business optimism in the US economy. And you can see pre-Trump and then how it skyrocketed when Trump was elected as president. Now, it stayed there for, you're jumping ahead a little bit, but that's cool. If it stayed there for quite a while, and this here is COVID. During that three and a half years before COVID came, and obviously COVID's not his fault, no matter how old we think he is, in that 3.5 years, the US economy went gangbusters. GDP was some of the strongest growth in recent time. The US share market rallied by 50% in that 3-year period. So whatever you think of Trump, he's very good at getting the economy going, even if, potentially that maybe stores up bigger problems for the long run. Taking that all together, kind of dispassionately looking at running the portfolio, you can see here where business optimism's been under Biden, just to get a contrast. Taking that all together, if we say there's a high probability the Republicans are going to control the Senate, we take that as given, then there's really three scenarios that we're preparing ourselves for. The first one, 50% chance Harris wins the presidency and can't do much. Divided government, a lot of pantomime, a lot of shouting and screaming. That's not terrible. We have divided government today. The US economy is still growing very fast. In most rich countries would be delighted to be growing as fast as the US economy. Unemployment's low. The US share market's been doing very, very well. So the status quo, with a lot of shouting and screaming, is actually not a terrible place for investors. Then there's maybe a 25% chance that Trump wins with control of the Senate. And if we do have that, I think it'll be modestly positive to markets. This backdrop here of deregulation, releasing animal spirits, I think could really get the economy going to some degree. And then finally, last scenario, Trump wins with control of the upper house and the lower house. And if that's the case, there's a real chance it's game on. He's determined to cut taxes, really stimulate the economy, be very inflationary, and we certainly wouldn't want to be short the market at a time when Trump's in power with his hand on all parts of government trying to rev the economy up. So that's the way we're looking at it. Again, we're not passing political judgment on any parts of it, but in any sort of particular outcome. But in terms of managing the risk and positioning ourselves and, I guess, talking to investors, those are the three scenarios we think people need to have in mind.
So we don't
G'day,
give
Jim.
you any more money until February.
Yeah, well, you might have missed the rally by then. You might want to give it to me on the 4th of November. Yeah, g'day.
That's an optimism index, which is not the same as how the economy actually performed, is it?
It's not, no. So it just measures small business optimism, which is like one of those sentiment figures that people watch quite closely. And it's important in the sense that small business employs something like half of the economy. It's most of startups. It's where a lot of the excitement happens. Not all, but a lot. And it's generally a pretty good proxy for the potential of an economy. So when business optimism is low, that's generally a bit of a harbinger for bad growth. And when it's high, and I don't have the figures to mind, but I think roughly during that time, the US economy was growing at sort of 3.5% per annum, incredibly fast. Now,
You would look at the optimism index alongside what the economy is doing, but then more importantly, what the share market is doing. And I think obviously it's really important that you guys look at the probabilities, and you have looked at a scenario where Kamala wins with the Senate as well.
yes.
Because of course that is,
Nothing's guaranteed.
everything is a probability, right? But interestingly, in terms of the US, and just to kind of put it into perspective of why it's so crucial in this day and age for global financial markets. When I first came into financial markets in like 2000, the mantra was always that the US kind of made up 50% of global markets. The US has been so incredibly strong over the last decade in particular, that it now makes up 65% of global financial markets. And when you consider that massive change...
And that's happened at the same time China's exploded. So despite China, the US is still taking an enormous
Exactly,
amount of market share.
exactly. So it's looking at but this optimism, this is the best thing we have in terms of small businesses and getting a finger on the pulse. But obviously you would need to look at those alongside what are financial markets doing, what is the economy doing, and it is going gangbusters.
Yeah. Growth during that time was about 3.5%, which is incredibly strong for a big old economy like the US. The economist in me worries that you're mortgaging the future to a degree. You're spending more than you're bringing in, you're racking up the big debt, but in the near term, these things can be very inflationary. We'll have time for more questions at the end, of course.
Yeah, absolutely. And you're not passing Miles isn't passing a judgment on whether these policies are responsible. I mean, I think Trump wants to spend $8 billion, $8 trillion, sorry. Kamala wants to spend $4 trillion. Is that responsible in the long term? Probably not. But we're looking really at the short term and what that might mean for the portfolio.
So I'll let Mark talk about a couple of case studies, and then we're obviously here for questions formally or afterwards over cake and coffee.
Good morning. Hello. So we've got 2 case studies to talk about. One of them is currently underway in the portfolio. Another one is completed. As Emma mentioned, they talked about it last year, so it's a bit of a part 2 final instalment of that. It's on the screen already. You're there already. So the first one is US Masters Residential Property Fund, or to go by the ticker, URF. Now this has got some history to it. I didn't want to spend too much time covering that. I wanted to focus on why it's become a meaningful investment in the portfolio today. Now, for those that don't know this, URF is a trust listed here in Australia that owns single-family residential property in New York and New Jersey. Essentially, this is a REIT. It was launched years ago at $1, traded well initially, then went to a deep discount, which is where we turned up on the register. Now today, URF trades on a discount of 37% to asset backing. However, the shares have actually done pretty well this year. This had been trading at around half of the value of the assets at the end of last year. Now, when a fund trades on a discount of that level, the first question you ask yourself is, how accurate are the asset values? Now, in the case of URF, they sold over $200 million worth of assets between 2019 and 2022. They've then sold another $150 million worth of assets since early 2023. And before costs, those sales have been remarkably close to the carrying values. The issue URF has is negative cash flow. The yield on the portfolio is very low, and on its own is not enough to pay the interest on the debt and the company's running costs. So the key consideration is therefore, how do you get this substantial value out of the company as quickly as possible and back to us shareholders? And for that, you need the right incentives in place and the right governance arrangements. And that's something that the board and key shareholders, such as GVF, have been focused on. As such, the fund today is in wind down. You have a manager that's got all the right incentives to sell assets as quickly as possible, whilst also maximising value. And you have a board that's completely accountable to shareholders. I don't have a chart here, I'm afraid, of the share price, but if you looked at the share price for some time, it went nowhere. In US dollar terms, which is the way you should think about this, the share price just went sideways for quite a while, and it was difficult to see any improvement. Now, the chart on the bottom left here shows monthly asset sales since they resumed in January 2023. As you can see, they took a while to get going. However, they've really accelerated this year, and particularly in the last few months. Which brings us to the chart on the bottom right here, which shows you that even while the majority of that cash has been used to repay debt and to fund buybacks, you still have cash that's built up, equivalent to about 30% of the current share price. About 15% of the current share price is represented by cash that is truly surplus, and that could be paid out tomorrow. The reason it hasn't been paid out yet is because the fund is currently doing a review of how it repatriates cash from the United States in the most tax-efficient way possible. Now, we never assume any saving. We're just assuming we're going to pay the full whack on tax. But the dotted red line here gives you a sense of that additional upside if they manage to crack that puzzle. Mm-hmm. So this is, this isn't a new story we're bringing to you today. We've talked about it in previous commentaries. We also own different instruments further up the capital structure in the past. However, it is one where we feel like things are finally starting to happen, and we're feeling pretty positive about this going forward.
I'm like a peanut gallery. Can I just
Yep,
quickly
of course.
step in? So just quickly on this one, to give you a sense of the life cycle of the trade that I was referring to earlier in terms of the strategy that we run. This was a product launched by Davidson's, which you guys will all have remembered from the press. At the time, it was a fantastic product. It was a product of, let's offer Australian investors access to US real estate. We all love property. It was at a time where the Aussie dollar was above parity with the US dollar. Good product. Governance at Davidson's, not so good. We all know the story. This was the poster child of Davidson's clients kind of running away from a terrible situation. As those clients were running away, we are the type of investor that runs towards, looks at, are these assets still good? Do they still make sense? And if so, can we get involved and not only benefit from the underlying assets that we've purchased, those US, New York, Manhattan real estate, benefit from that, but also benefit from getting this product back up to parity. And that Mark has really underplayed what him and the team have done. They were the ones who put this into liquidation. They were the ones who fought off corporate raiders who try to come in and steal some of the assets. It really has been a hands-on project where we've gone in there, advocated for shareholders, obviously our own shareholders, and then turned it around. It's still a work in progress. We're still selling off those properties, but ultimately, this is the type of trade that illustrates what we do.
So that's one we can come back and revisit in the future, and you can see how accurate we were, or how right we were on that one. On that note, so Mars and Emma talked last year about our investments in the music royalty space. At that time, they were probably talking about a company called Hypnosis Songs Fund, where the news flow around there was pretty messy, but we were really confident on the value of what we owned. So this is going to be part 2 of that story. For those who didn't hear this last year, most of you will be familiar with the concept of song royalties. When you buy these rights from artists or songwriters, you're buying the right to receive income every time it's played on the radio, or a CD is sold, or it's streamed. And one of the reasons people have been excited about this is this growth in streaming you can see on the bottom left here. So this chart shows revenues for different technologies. So starting with vinyl, you've got cassettes, you've got DVDs and CDs. Then you have this trough as piracy came in and people downloaded MP3s. Then finally towards the right, you have this just exponential growth in streaming. Another reason why people are quite excited about this as an asset class is the potential to extract additional revenues. And a great example of the power of this would be Stranger Things on Netflix, which introduced a whole new generation of people to Kate Bush's music, saw her get to #1 in the singles chart all over the world, including here, I believe. And that was for a song that was first released in 1985. Now, there were 2 vehicles that IPO'd in London to do this. One was called Hypnosis Songs Fund, and the other was called Round Hill Music. Hypnosis Songs Fund had the great ticker Song. They got there first. Now, back in early 2023, when these were trading at deep discounts to NAV, we built a sizable position in both, as you can see from this chart here. Is there a grey area on this chart here? I can't quite see it from where I'm stood. There should be a little... There was a little grey zone. So we were buying around here. Now, shortly after we purchased a stake in both companies, we were vindicated when Round Hill Music, RHM, got taken out over 60% above our entry price. That, however, only increased our conviction in the remaining investment, Hypnosis, and so we increased our position even as the price drifted lower and the news flow got more and more negative. And you can see here what a sort of pain trade that was over that period. Now, these were similar investments, similar companies doing similar things. They were valued by the same valuation agent, and they ultimately had the same outcome. But there were 2 very different paths to get there. In the case of Round Hill Music, it was all very easy. A buyer came in, negotiated with the board, they presented it to shareholders, we were delighted to take it. In the case of Hypnosis Songs Fund, however, shareholders had to really roll their sleeves up and fight for it. Now, to skip over a very busy time for shareholders, we, shareholders, blocked the company selling a big portion of the assets to the manager at a large discount. We voted against the company continuing in its current form. That then triggers a 6-month process where the board has to go away and come up with an alternative plan for the future. We also changed the board, so we sacked the chairman. 2 other directors resigned on the eve of the AGM, so presumably had been voted off as well. We also put forward 2 directors, one of which became the chairman, and that chairman had been the chairman at Roundhill Music, so he'd had experience going through an M&A process. He understood the investment company audience, so his shareholder base, he understood the asset class, and he'd gone through this M&A before. Happily, on 18th of April earlier this year, Hypnosis Songs Fund announced a takeover bid, a recommended takeover bid, that was a 33% plus premium to the prior month-end value. That, even better, triggered a bit of a bidding war between Concord, who was the buyer of Roundhill Music, but also the initial bidder of these assets, and Blackstone. Now, Blackstone, the large US private equity firm, was the owner of the manager of Hypnosis Songs Fund. So you had this bidding war play out, and ultimately, Blackstone came back and bid a 12% premium to that initial bid. So all in all, we got out at about a 50% premium to that end of March value. So the deal completed in July. By that point, or well before that, the share price had pretty much converged to that deal price. So we had a lot of opportunities at that time, so we sold up and put the money into those instead. However, the Song investment was an IRR, or an annualized return, of 39.4% for the fund.
It should be said, and I know we say this every time, but the majority of the portfolio that we invest into is shares. So it'll be vehicles like that invest into shares and into bonds. So we've got about 30 to 35% in global shares, 30, maybe 25 to 30 in global bonds, and then we'll have hedge funds, private equity, music royalties, etc., that then very much diversify our underlying portfolio. And the case studies we've chosen today are really out of interest more than a representation of the majority of the investment. What I like again about this case study was this was a product launched in the UK. It was launched to UK investors when interest rates had been at 0 forever, and it was a great story. The story was, okay, we can give you uncorrelated income. We can link it to this fantastic story of Spotify, all this money going into music, and we can pay you 8% per annum. And that was very attractive when it launched, and you can see that both companies traded very well at premiums. Then interest rates they rise in the UK. Suddenly, a UK investor can buy, an HSBC. They can put an HSBC deposit on, get similar returns, and they're not so interested in this anymore. It sells off. That's the point at which we get interested. And genuinely, when Miles and I came out here last year, we came out about here, and this was luck. This was, obviously great investing. Brilliant investors were behind that, but also it was a function of luck, and we were very chuffed that, but I'll be honest with you, this period here was very uncomfortable, and was a huge amount of hands-on work, which the team did. So again, and got there in the end, exactly. But yeah, I wanted to. So thanks, guys. That's what we have, and now it's time for Q&A. If anyone wants to ask some questions.
What's your exposure to the American property trust?
Yeah.
So it's about 4% of the portfolio.
4%.
Normally, a normal size position would probably be about 5%. This is a bit, the property trust is a bit riskier. So we've sort of sized it down a little bit. Riskier means obviously it can go against you, but also you don't need a lot of it to make a lot of returns if it works out for you. So we're still very excited about it. It's made us a lot of money this year, and we still see a lot of value to come out. G'day.
What's the time frame to wind that up?
Yeah, that's a tremendous question. As a reminder, there's really 2 ways we go about making money with our special strategy. The first is finding these, they sound very exciting, deeply discounted asset plays. There's normally some corporate story, Mark, myself, the team, roll up our sleeves, remove directors, tidy things up. And those things can range from 1 year to 3 years. URF, we've been in for about 2 years already. But when you're buying something at 50 cents in the dollar, there's a lot of value to play for time. So even though it might take us 3 years to get out, we're hoping to get a teens kind of investment return over that journey.
How much longer have we got to go?
I think sort of the management agreement that so Brooksville is the manager that's been appointed.
Stand by the mic.
The Brooksville is the manager that's been appointed to do this. They've got a contract that goes till, I think it's the end of 2027. So you're talking about 3 years roughly from now. Obviously, we're not expecting the money to all come back at the end of that 3 years. So the sort of weighted average time frame really is, is half that, 1.5 years.
So you expect to get the last dollar back in 2027. We've already started getting money back along the way. And then just to say, so deeply discounted asset plays, they can take a long time to extract the value. The other side of this business is a really interesting trading book that we've run for nearly 20 years, where if you don't run much money, and that's one of our raison d'etres, not to be too big, to be light on our feet, you can exploit these really interesting arbitrages, real-world arbitrages in our world, in our space, taking advantage of liquidity events, buybacks, tender offers. And we find that stuff fascinating. We can't scale it up, but they're really interesting trades. And the two businesses really complement each other well. They nice diversity of sources of alpha. G'day.
Miles,
G'day.
with the LICs in Australia, because of the interest rate movements in the last few years, even though the major ones are trading at still quite big discounts to NTA, is that common across the Western world or the developed world?
I mean, that's a tremendous question. So just so that it's clear for the mic, the question was, you have Australian LICs at the moment trading at meaningful discounts, and one of the good arguments for that, or one of the main arguments is interest rates have gone up a lot. LICs are typically seen as dividend plays, so you've got an alternative now. You can put cash in the bank. And the gentleman's question was, do we see that across the world? I think one of our biggest strengths is that we're not fussed about where we invest. So we invest everywhere, from Canada to Japan, the UK, the US, and there's always a story going on that moves markets around. So as an example, in the UK, Mark will moan to you over a coffee later, new Labor government's come in, needs to raise money, and one of the things it looks like they're going to do is increase capital gains tax. It's been talked about in the press for months and months and months. Now, a lot of they're called investment trusts in the UK as opposed to LICs, but they're the same product. It's a much bigger market, and some of these trusts have been going for hundreds of years. One of them, the F&C, Foreign and Colonial, was the oldest investment trust in the world and was actually set up to fund the American railroads back in the 1800s. That was its original purpose. A lot of old people holding these things for a long, long time have a lot of capital gains. So the prospect of a change in capital gains tax rate has meant there's a lot of selling in these things at the moment. So at the moment, we're buying these things incredibly cheap. The budget is released on the 30th of October, when we'll know for sure what the tax rules are. And then post that, we would expect things to normalise. In the US, it's such a big capital market. There's always some theme going on, Canada, other jurisdictions. But we move around the world where the opportunities are. We've had times when nearly a third of our portfolio was in Australia. Back when they were talking about removing the franking credits, the LICs in Australia got very, very cheap. More recently, we're not doing a lot here. Not that there's not interesting things to do, it's just the most exciting things to do are not in Australia.
The discounts probably haven't moved out enough. I know what you mean, AFIC, Argo, all trading on historic discounts for Australia, but still not probably tempting enough.
Not big enough discounts.
Yes, at the moment. Yeah, and no obvious catalyst with those guys. But you're totally right. I mean, it's totally cyclical. I think the LIC space in Australia is going through a total consolidation phase, and it'd be interesting to see where it comes out on the other side. Hopefully stronger, hopefully more concentrated. And also, I think it's so crucial that if you are running a listed investment company, that you're running a strategy that should be in a listed investment company. There are many strategies that if they can be run in an ETF or an ETMF, they should be run in an ETMF. So yeah, I think we'll see that kind of changing and hopefully making the space better, because I genuinely think that the listed investment company space offers such a wide range of alternatives to investors.
Well, both Argo and AFIC have said that because when interest rates got hit 10 basis points, traditional fixed interest investors just threw up their hands. They were never equity investors, but they had nowhere to go.
Yeah, exactly.
So they bought the yields with the franking credits and the two big LICs.
Yeah, and you're seeing possibly an unwinding.
Rates came up.
Yeah.
They got back where they wanted to be.
Exactly.
So they bailed out. So they saw big growth in their shareholder.
Yeah.
Now they're seeing it come back. but the assets are very solid and they're both very well-run companies.
Exactly.
So, you know, they should get closer to a balanced situation.
And that's the opportunity. I mean, it is. I know it's such a cliche to say, but it is the opportunity. You can get in at a discount, which is exciting for many
Buy
investors.
a great portfolio at 90 cents in the dollar.
You're
You've got a
basically buying
tremendous long-term
share,
track
global
record.
shares, you
Yeah.
know?
So
Yeah.
you're saying as interest rates come down, they'll
LICs.
Buying back in LICs.
You would,
That's one of the arguments in the market. Yeah, that's one of the arguments. So as interest rates go down and the marginal investor's more keen on yield, they can't get it at the bank. The argument is they might come back.
Especially if franking credits stay and if
Exactly.
interest rates drop to a meaningful low, which
Yeah.
is doubtful. If they do, then they could be attractive again.
Yeah.
It may not be like a 10 basis point.
No, it may not go that low.
No.
No.
We're going to see that again. I'm going to see that once in our lifetime.
Yeah.
I hope we don't see it again.
Hopefully.
Yeah, because
Can I just comment on the private equity markets, and I speak in the context on the number of listed companies are sort of shrinking around the world.
Yeah.
And I mean, that's a normal exit for private equity that doesn't seem to be happening, and is the markets clogging up there somewhere?
Well, it's a fascinating point. Emma and I gave a big talk about this at the Australian Shareholders Association. But for the camera, the gentleman's question was any comments about the private equity world, I guess. And one of the big features is the shrinking amount of companies on listed exchanges. I mean, an incredible statistic. I think 15, 20 years ago, there was 8,000 companies listed on the US stock exchange. Today, there's less than 3,000. So there's two drivers to that. One, small, and this is probably, I think, the most interesting dynamic. Small startups today don't come to the public markets to raise money. So back when I started in this game, being listed on an exchange was the place you had to go. It's where all the big investors were, the most sophisticated investors. Today, if you're an entrepreneur with a great new widget or a great new idea, you go to a venture capital fund. And if your widget works, you go and raise money from a private equity fund. And if it continues to work, you probably get sold to a different private equity fund. And a whole generation of companies that used to come do an IPO for $100 million, and maybe they work, maybe they don't. And if they do work, they raise $500 million a few years later, and they grow, and one day they turn into BHP. That whole generation of companies is now happening in the private equity space. And on the other side, private equity has gotten so big with so much capital to deploy, really anything that's interesting or exciting gets taken off the public exchanges. Private equity turns up and goes, that's a really good company at a good price, but the market won't value it as such. I'll grab it and I can take a 10-year view. So I think one of the big changes in markets over the last 20 years has been the shrinking of importance of listed companies, which is sad in a way because it locks retail investors especially out of what is normally an institutional game, private equity. I mean, the companies are changing ownership from public listed spaces to private enterprises.
Do you think tighter compliance issues on the listed exchanges have partly led to that for the smaller businesses?
100%. I mean, one of the big parts of our speech, I think one of the big drivers is regulation, litigation and cost. It costs so much money to run a public company. You're under so much scrutiny. Like these days with all the culture wars, if you say the wrong thing as a CEO, you get shouted down. Same company could be buying coal mines. I mean, all these coal mines are getting sold today. They're not getting wound up. They're just going into private equity hands where no one points the finger at them. It's not, in my view, the best way to allocate capital around the economy, no. It's a bit sad.
But your question, so did I understand correctly? Your question was, what are our thoughts on the fact that...
Well, you wonder where all these private equity companies are going to end up. Are they just going to continually trade in between private equity companies, or
Yeah.
where are they going to go? There's no
So
listing
we own some private equity, listed private equity in various forms, and we bought them at really exciting discounts. And so we know a lot about this game. Mark is really our resident expert, but I think there's probably two main things going on in the private equity space today. One, everyone's sitting on a lot of companies they haven't been able to sell. And this is a function of the IPO market being closed. And they're getting more and more innovative in terms of how they sell these. Do you want to talk about the GP?
So there's,
buyouts and things like
yeah,
that?
I mean, there's a few. The first thing to say is the private equity trust that we own, they tend to be a bit more biased towards the small to mid cap end of the market, so that they just have so many more options when it comes to exiting. Generally, they've got the choice of IPOing it, but also selling it to a trade buyer or a strategic buyer, or another private equity buyer. Sorry, were the other?
In terms of like the GP-led buyouts.
Well, yeah. I mean, the other thing that some of these companies have come up with is these GP-led secondaries. So what you'll do is you'll get to the end of the life of your fund. You'll have your trophy asset there. you think there's no way I want to sell it in this market, this is a terrible time to IPO it. So what you do is you go to your investors and you say, look, you can either have your money back today, or you can follow me for another 5 years. And if they don't want to participate in that, you bring in new investors, and then you sort of go again just for that investment. And then you buy out those investors, you carry on, you roll your performance fees into that investment ideally. So that's another solution that they're coming up with. So they're not having to come and IPO these companies
so
today.
essentially these funds, they're sort of sitting on a lot of stale investments, and they're coming up with innovative ways to extend the duration of them. And I think in terms of us and what, I guess, my view on the space and what I think will be the catalyst is everyone's waiting for the exits to turn up. So markets have rallied a hell of a lot in the last 12 to 18 months, and at some point you'd think the IPO window starts to reopen. So I think that's kind of the catalyst we see, if there is to be one.
Curious, can I take your question further? Where do you see it ending up? So do you just see it there being no listed space? Like, what is your vision?
Yeah.
Like when you think about it, because I think a lot of this has to do with the ETF world, right?
Yeah.
The ETF world came along, it kind of copied everything that was out in it, and that meant that we decided a lot of companies don't want to go to the listed markets because they'll just be copied by an ETF, and there isn't really that. But so where does it end up? What happens? Do you have any? Obviously, no one knows, and we'll probably be dead when it happens. But do you have any thoughts?
Well, I guess the dystopian kind of view would be it continues in this path, and more capital. This is just my view, but we'll have our own views. More and more capital ends up in the private equity space, and what's left in the public markets is very specialist sectors. Here in Australia, I think mining is a good example of that. It's a very capital-intensive, mining and oil and gas, resource extraction, very capital-intensive kind of business, but it's a very specialist business, and it's probably beyond the risk appetite of most private equity funds. So I read that example I gave before, where you get like the entrepreneur with his little widget maker, and he goes to a VC fund. The exception to that in Australia would be the mining space. You still today get entrepreneurs, geologists that found a gold mine in the Congo and they want a lazy $50 million to drill some holes. That still very much here happens on the public exchange. And I think that kind of dynamic part of the market stays. So I can see specialist parts of the market surviving and thriving, healthcare, places like that.
Okay.
And I think this benefits the ETF world. I think they're talking their own book. Then you still have the behemoths, so things that are way too big to be taken private.
Yeah, okay.
No one is taking BHP or Wesfarmers private.
Or any of the Mag 7 or any of the
so
top
JP Morgan
100.
or
all those kinds. So businesses that are far too big, today probably never come to public markets in the first place, but are so big and liquid that you can never take them off the public markets. And I think the public markets continue to shrink down to a very small number of stocks that fit beautifully into an ETF, don't offer investors a lot of actual choice,
Okay.
but work well for the people that they want it to work well for.
Are banks in other countries protected like the Australian has the 4 pillars basically? Are other countries protecting the major banks? Are they always be listed vehicles?
That's a huge topic. Most countries have that kind of desire to have a national champion, especially in Europe, fighting US influence. I remember being in London during the GFC, and I remember arriving in London and feeling and sort of being told Australia was a bit of a sleepy capital market and this 4 banks policy just to promote an oligopoly. And then I lived through the GFC in the UK, and I lived through the period where the regulator, the FCA, famously had this light touch regulatory policy. We'll let them, regulate themselves. They're the smartest guys in the room. And I saw it explode in spectacular fashion in the UK, and the pendulum swing back the other way. So I actually think the Aussie system, with APRA that Costello brought in and all that kind of stuff, holds together really well for what we need it to be, which is a very boring utility that we all want to use, not a mechanism for people to get rich and speculate.
But the nature of those businesses, what I was getting at, they will always stay public, isn't it?
I think so.
Because of
They're so
the
big.
government market, and they're so big.
Yeah.
And then the mining is such a cyclical industry too, that's why private equity is a bit,
Generally,
difficult to live with these cyclical cycles.
With the exception of coal mining. One of the really
Yes.
sad stories I don't see written in the press is that huge amounts of these coal mines are being sold to private investors out of the public eye, so they don't get all the greed. That doesn't, if you think we need to stop mining coal, and putting it into the private space doesn't get rid of that problem.
In Australia, exported from Australia.
Exactly, we just don't see it anymore, we don't hear about it, yeah.
So with the markets being, so strong, how come the IPOs haven't been?
Yeah, it's a great question. The optimists would say it's coming, that we're slowly opening up the window. I guess the problems would be you have the whole cost of living pressures on everybody, and the mood is still quite glum in some places. But I think I'm starting to read that people believe that window's perhaps getting closer. It is a bit strange it hasn't happened already, I'd agree. And normally you'd expect it to be.
I mean, one thing to add to that, well, you could talk about the concentration of returns amongst those Mag 7. So obviously a big part of the US market returns over the last year or so have been concentrated in that Mag 7. I can't remember the statistic, maybe you do, but just what it implied the rest of them did. I mean, they kind of brought nothing to the table, really. One other thing is that there's been some strength in the mid-cap market in the UK, but that's been because companies are exiting rather than, so it's not a sort of signal for people to IPO. It's actually that things have been trading on such big, deep discounts that private equity or other buyers come in and take it out, and then you just get this kind of 30-40% pop. So we've had a couple of M&A situations in the portfolio actually where, taking advantage of that exact dynamic, which is a nice little one-off pop, but then it exits the index and then it's gone.
Are you concerned about private equity, the growth in private equity worldwide, and inexperienced managers coming in, because it's the flavour of the month?
Yeah, I mean, I guess we were chatting about that. I mean, it's hard from the outside looking in to know. But you mean private credit? Sorry, private credit. The gentleman's question, that is quite interesting. So the gentleman's question was, are we concerned about private credit? And it's an extrapolation of this trend. So private equity has been so successful. These firms now manage tens and tens of billions of dollars are moving into private credit. It's not a particularly new phenomenon, so it's sort of newish in Australia, but it's been happening for a good decade in the US. We've invested it with or alongside some of these vehicles, always at a big discount. And we've seen lots of different scenarios. So some of them have played out really well, some Johnny-come-latelys that have kind of jumped on the bandwagon. And I think it's really, because it's such a new thing, particularly here, you've got to be very careful about what manager and what strategy you're picking.
Well, our banks moved out of a lot of lending to businesses and concentrated on housing because it seemed safer, so they opened the opportunity for
100% to come in, yeah.
Fill the gap in the market.
Yeah, no, 100%. I mean, one of the important things about it is none of these things are particularly liquid. So if you invest in a private credit strategy, you've got to realise you're not getting your money back anytime soon. You have to understand that when you go into the thing.
But the listed private credit trusts are sort of providing that liquidity to people.
Exactly.
Well run, if they're
100%.
Investment grade and,
100%, and that to Emma's point, I think that's one of the great things that a LIC can do. It can take a alternative, less liquid asset and turn it into something that's very liquid for.
I remember in March 2000, the GSC, when they COVID hit, one of the biggest ones in Australia's metrics.
Yes.
The NTA was still solid. They didn't have any liquidity issues or any bad debts. But the price dropped to 80 cents on the dollar. So
I remember very well.
$0.05
I think we might have bought a few back then. Yeah.
But it wasn't logical.
No.
There's no reason. But all the
fear.
big companies bailed out, the big super funds, because they were worried about liquidity issues and demands for money.
Yeah.
So they were the quickest things they could sell. And they hadn't been on the market that long, so they just dumped them and millions.
Yeah.
It really created an opportunity there.
Yeah. No, 100%. It's
logic sort of went out the window.
Yeah. Well, shall we call that a wrap? So thanks for the questions. Well, obviously, Emma and Mark and I will hang out outside. We can all chat over a coffee and a slice of cake. But thank you very much for making the time, guys. Really appreciate it.